Thanks everyone for attending. I know it's Friday, it's the end of the week. It's a long week. It's August. It's August 3rd. Next week is September already. It's going to feel like. But my name is Michael Valtos. For those that don't know me, I'll be talking about order flow and what you need to know about order flow. And my goal for you today is to teach you the most important part of order flow. And I'm going to explain some new developments in order flow analysis. I'll show you why you don't need to predict the market to be a successful trader. A lot of people think, well, they like to try and predict where the market's going, in 3 weeks from now or, 3 months from now. No, you don't need to do that to be successful. You can just trade what the market is telling you to do. And I'm going to show you how, hopefully, I'm going to convince you rather, to stop waiting for confirmation and start trading. Being a trader is about taking trades. And, this morning we had the non-farm payroll numbers come out, and earlier than that, it came out at 8:30 Eastern time. But this morning, about 3:30 this morning in the E-minis, there was a great order flow trade setting up, and, right off the lows of the day, you could have bought those lows around just off at 28.26 and a half, 28.27, and it rallied all the way up until about 7 in the morning at 28.35. That was a beautiful move, and it showed up perfectly in the order flow. So what I'm presenting here is what I've developed for myself and built my trading career on. I come from a trading background. I was a professional trader. I hate to use the term professional trader, but I was more of an institutional trader where, that's what I did for a living. That's what paid my bills. That's what, paid for my house, paid for my food, paid for my car, everything. And it wasn't something I just did in my part-time and said, hey, you know what, I'm going to come out and sell this. No, that's what I did. I was an institutional trader at a very high level for many years. And I hope you can find things that you can use or modify and adapt in your own trading. That's what trading becoming successful is about, is adapt, taking what works for you and going from there, running with it. It's not about someone just say, here, this is how you trade and you have to do exactly as I say. No, you may find a better way to use that information and help your trading. Now, I'm not saying that you have to follow what I say just because I say it. You have to evaluate everything you come across, whether it's from me or from one of the other speakers here today, and decide if it's going to help you. If not, you reject it, then you look on for the next bit of information that's going to take you the next step further. And for those of you that stick around to the end and don't have a copy of it, I'm going to show you how to get a copy of my book, Trading Order Flow. It's a 150-page book. You'll get a copy of the PDF. You're not going to get an actual hardbound copy sent to you, but I'm going to show you how to do that at the end of the presentation. Now, again, for those that are first time on this presentation with me, I just want to talk about my background a little bit. I've been involved in the futures industry now, gosh, it's going on about 25 years. And for the last 3 years, I've been the owner and trader at Orderflows.com, which is the order flow trading software you're going to see presented in this presentation. But prior to that, I spent 8 years at JP Morgan as vice president of futures trading. And I was a trader there. I wasn't like someone sitting in an office looking at spreadsheets and coming out and saying, hey, you got to reduce your risk or you need to start trading more. No, I was an actual trader on the trading desk, coming in at 5 in the morning, leaving at 5 at night. I spent 3 years at Commerce Bank as a licensed Eurex trader. I traded all the interest rates and European stock markets. And I spent 4 years at Cargill as a trading desk manager. I even helped them set up a futures trading desk in Singapore when the exchange closed down there. I spent 2 years at EDF Man, the big English trading company, as a global macro trader. I started my career in the futures industry on the CME floor as a runner with Dean Witter. I literally got started on the bottom. It doesn't get any lower than that in the futures industry. And I left the floor when electronic trading started taking off. When Globex started being active, and you had Project A from the Board of Trade, you had NYMEX Access, and I just saw that that's where the future was, and I wanted to position myself in that direction. Nowadays there's no trading floor that you can just go down to and beg somebody for a job. It's a bit harder. You need a certain background, you need a certain degree to even get your foot in the door to get an interview. And so the barrier of entries have changed, and that's why I like doing these presentations, is to share my knowledge for people that are interested in trading that don't have access to traders, that don't have somebody with trading floor experience or trading desk experience that they can listen to speak. Now, in 2013, I left my job at JP Morgan. I'd been there for 8 years, and I don't want to say it was killing me, but you know what? At the end of the day, it was a job. It felt like a job. Even though the pay was great, People were all right, but you know what? I was spending more time there in the office than with my family. I already knew how to trade, and I said, you know, I had to make a decision in my life. You know, is this what I want to do? And come into the office every morning, spend 12 hours in the office, go home and spend, you know, less time with my family. You know, so I made that conscious decision to spend more time with my family. You know, you only get one chance to watch your kids grow up, and I wanted to spend that time with them. And so I started trading by myself, and I started writing a book. You know, I always wanted to write a book, and writing a book is hard work. You know, it's a lot harder than I thought. I thought, you know, oh, I'll just sit down and start typing, but it wasn't. And it took me a while to really get my head around that, you know, writing a book is hard work. And while I'm trying to trade, and you know, it was frustrating because, you know, at that time, you know, there was only a handful of volume footprint charts out there to read the order flow, and I just wasn't really happy with what was there. You know, I like to look at 3 or 4 markets at the same time, and sometimes if I'm in a trade in one market, you know, it's got my attention. I'm not really focused on what's happening in other markets. So I find myself sometimes missing trades, and that had always bothered me. And I know that computers can do more. Computers can really do a lot of analysis for you. And I said, why isn't anybody coming up with some form of program that can help me in my analysis? Now, you know, I have my own type of analysis that I do with the order flow that I've been using for years. And I said, I found a programmer that understood order flow, and I said, hey, let's put this into a program because it's going to help me um, analyze the markets more, go more in depth in finding where there's price rejection, price support, absorption, and other market nuances. So we came up with the Orderflows Trader software, and it runs on NinjaTrader 7 and NinjaTrader 8. You know, it's NinjaTrader is good for retail traders, and you know, this really opened up a door for me because, you know, when you're trading for yourself, you know, when that's what's paying the bills, as opposed to working in a bank, and I know I'm going to get a paycheck at the end of the month, regardless if I make money or lose money. You know, I can trade differently, but when I have to trade for myself and use that money to pay the bills, you know, I want to be able to access more markets. I want to be able to see, you know, minis, crude, you know, Dow, NASDAQ, Euro currency at the same time. So, you know, that's why I needed to advance the tools that I was using, because, you know, that way I could have more trading opportunities as they come in. So, you know, let me be clear, you know, with the order flow, you have to make trading decisions. You know, that's what trading is about. It's about making decisions. And order flow allows you to view the markets in ways you just haven't before. And, you know, the way I would describe it is, you know, like being a doctor, okay? You know, if you're a doctor and a patient comes into you, you don't necessarily know what's wrong with them until you start, you know, taking their temperature, checking their pulse, looking at their x-ray. And that's what order flow allows you to do. It allows you to see inside the patient, in this case, the market, so you can make a better trading decision and understand what's going on with the market, just as you would understand what's going on with the patient. So you know how to address the problem, or how to address the trade, or take a trade. But before I begin, a brief disclaimer. This presentation is for educational and informational purposes only, should not be considered a solicitation to buy or sell a futures contract or make any type of investment decision. Futures trading contains substantial risk and is not for every investor. Investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. And, you know, it's important, you know, because I like people to realize that, you know, there is risk involved in trading. You know, it's not riskless rather. If there was no risk in trading, everybody would do it and everybody would be making money and it'd be happy days. But it's not like that. You know, people come in, they lose money. I just want you to be aware, you know, and that's why I like doing these presentations, because I like to make you aware of that, and I like to help you find an edge in your trading so that you can be successful in your trading. Now, in order flow, there are 3 building blocks that you need to know to understand the order flow: delta, point of control, and market imbalances. You know, and it's with these different pieces, once you start putting them together, it's like Legos in a sense. You know, you start putting them together, and all of a sudden now you have a nice, neat little house. You know, it's information that's available to everybody, and it's whether or not you have the software to analyze it, to look at it, and take that information, that raw data, and put it into an easy to read format. Now, first I'll talk about is some of the new developments in order flow analysis. Now, like I said, you know, back in, you know, 2013, 2014, there was just a handful of order flow charts out there, and Like I said, I was using it and it's fine, but I know computers can do a lot of the heavy lifting for you in terms of analysis. And so I sat down, I wrote down, how I would analyze the markets. And when I met my programmer, I explained to him, I said, okay, take this information, put it in there. This is what I want it to look like. I want the order flow volume footprint chart to tell me where there's trap traders or where there's divergence and support or resistance. So we came up with the original order flows trader, which has trap traders, single prints, order flows, divergence, and ratios, and they all tell me different things about what market conditions. But recently, earlier this year, we came out with a big, I'll say quantum leap, but it's a big jump in terms of analysis because I've added in a few more tools to help the trader. I've added prominent point of controls, market sweeps, market in multiple imbalances, and I enhance the trap traders to show more areas where traders can be trapped. And I'll just talk about those briefly. Prominent point of controls, highlight the point of controls. Now, a point of control is a point in the bar with the most volume, and there's certain point of controls that are going to be important, and those are the prominent point of controls, and they often act as support and resistance. And once you know areas of potential support or resistance, you can take advantage of them when the market reaches those prices again. So prominent point of controls, you can see on the software is highlighted with a blue for support or a magenta, which is kind of a purple for resistance. And oftentimes the markets bounce around between support and resistance. And there's other times where you retest those levels. So again, what this goes back to what I was saying is understanding if you know that there's potential support or resistance, you can play it that way. You can trade it that way. When the market comes back to those levels, you can be sitting there lying in wait, waiting for the market to trade that level to get long or rally back up there to get short. Those are low risk trading opportunities. We all want low risk trading opportunities. And this is a great way to find those low risk trading opportunities is by knowing where there's support or resistance in the market. And that's how order flow is going to help you. And I'm going to jump into that a little bit more in depth later. Now, market sweeps are areas where big traders sweep the market. They buy or sell through several price levels in one trade. Now, people are going to say, oh, why would somebody buy through, say the market is 5 bid at 6, why would someone pay up to 8? Well, it's because somebody wants to get into a position. They know that their activity is going to move the market, so they want to get in as fast as possible, get on as much as possible in the shortest amount of time. And market sweeps are often great preludes to big market moves. This is a NASDAQ. You see a market sweep occurring right here. That's what this red arrow is. This is what my software does, is it highlights that. And you can see a market, how a trader came in and swept the market lower. Over the next 1, 2, 3, 4, 5 minutes, you can see how the market sold off from 71, 72, all the way down into 71.55 area in 5 minutes. And understanding what a market sweep is and identifying it in the order flow is going to help you. And again, it happens every day, but most people don't understand when it happens. And so you have to be able to react quickly. And that's what the order flows software can do for you. Now, again, here we got a swing low, got a prominent point of control. So there's support in the market. Market starts rallying up. Boom, you get a market sweep here, and then the market continues its rally. So, what's happening? Think about what's happening in the market. Market's selling off. We hit an area of support. Okay, the market starts rallying a little bit. Then boom, all of a sudden traders come in and said, maybe some guy's got a big order saying, hey, I think we're about to rally. Maybe he's doing something. This is crude oil. Maybe he's doing something against the cash, and he wants to get in on his trade. So he'll sweep the market. He'll just buy it. Hey, we just started rallying and we got a little bit of selling action. This is my second chance opportunity to get in, and he sweeps the market right before it starts taking off again. Multiple imbalances. Again, I'm just talking about these new developments in the order flow here. Multiple imbalances are 3 or more order flow imbalances in a bar. And it's similar to a stacked imbalance, in stacked imbalance. Only the difference is it's not stacked on top of each other the way a stacked imbalance is. They may be mixed in there in the bar. So, for example, multiple imbalance, it will draw a box around the bar, okay? And coming into a swing low, aggressive buying. What causes an imbalance is aggressive buying. When you have generally 4-to-1 ratio, more aggressive buyers and sellers, people lifting the offer than hitting the bid, or for aggressive selling, people hitting the bid versus lifting the offer. And you can see here, you have multiple imbalances, but up here you have a stacked imbalance. So let me ask you, where would you rather be getting long? Right off the low, where you see the multiple aggressive buyers coming in, or way up here 20 ticks later where you got a nice, neat stacked imbalance. Yeah, you'd rather be getting in shorter. But again, if you're just looking at stacked imbalances, you're going to miss these multiple imbalance bars, and it's very important in trading as well. And you can see here another great example. The market's coming into a low, just sort of hanging around before it takes off. Well, what's your sign right before it takes off? Is you got aggressive buyers coming in here in the multiple imbalances. You got 1, 2, 3, 4. And then boom, the market takes off. But again, if you're just looking for stacked imbalances, you'd have no clue here. You wouldn't know what's going on. You'd just be like, oh, okay, we're coming in, we're starting to rally. But if you can see that, hey, you know what, I've got a plethora, so to speak, of aggressive buyers coming in here, it could be a nice trading opportunity. And if you're willing to take it, you're handsomely rewarded. Here's in the euro currency, here's a double top. You got your divergence and you got multiple imbalances happening right at your high of the day. You're coming into a high. Earlier you hit the high, you got a prominent point of control, so there's support. You come back, you circle back up to that high. Now you got a divergence. Now you got negative delta at the high. That's this arrow. And then you got multiple imbalances. So you have resistance. You've got divergence. You've got multiple imbalances. You got aggressive sellers coming in here. And what happens is the market sells off. I mean, these are the new developments in order flow. And, it boggles my mind sometimes. I see the same order flow software that I used back in 2013, and it's just the same. They've made no improvements. And, the whole point of me creating this software, these tools, is to have me like sitting next to you trading. It's telling you, hey, there's market nuances here. And it's just a shame because, order flow is a great tool, and a lot of people, I think, are missing out on order flow because, one, they don't understand it, and two, they don't have the right software to help them understand it. So, those are the new advances. So the second thing I'll talk about is the most important part of order flow. And it's not some big secret, guarded secret like like the Jedi Knight's secrets. The most important part of order flow is volume. And why is because volume, something that trades, shows a trader's commitment to the market. Once you're into a trade, at some point, generally they're going to get out. Now, people say, no, not every time. Yeah, I understand about deliveries. I know about deliveries. I've had to take deliveries myself on things in the past, but 95% of everything that's traded, maybe even higher than that, at some point somebody gets out of. So once someone gets in a position, at some point they're going to get out of it. So it shows that they're committed. Now, people like to argue, well, trading on a dome, the depth of market is really order flow. No, well, well, technically that's orders going in. It's not orders being traded. And unfilled orders indicate the trader's intention, while filled orders, things that trade indicate a trader's commitment. And for example, okay, here's your dome, right? You see market's 28,909.5 bid offered at 09 3/4. But you can see up here at 2810.5, there's 1800. People like to say, well, Warren Buffett, Bill Gates, they're trying to sell up here. Well, I'll be honest, if the market's 9.5 at 9 3/4, yeah, I'd love to sell at 10.5, but it's not going to happen, right? The market's got to start moving up. And if you've watched the dome long enough, as the market generally starts to tick up, this big volume up here starts to thin out, okay? So it's just someone's intentions, showing, all those 1,200 at 11 1/4. There's probably more there. There's probably more up here at 11 1/2. Of course, when the market's trading 9 1/2, everybody would like to sell 11 1/2, but it's not going to happen, right? As the market starts ticking up, where are those guys? Are they still there? Are they gone? Oftentimes it starts thinning out. Instead of, say, the market gets up here, starts trading 10 1/4, next thing you do is you look up at 10 1/2 thinking, well, there's 1,800 there. No, there's only about 600 left there. Everyone's got scared. They pulled it out, they backed off. Now they're trying to sell it at 11 1/2. So it's just traders' intentions. It's not a commitment. Whereas on a volume footprint chart, you could see the volume that's traded. You could know that, hey, at this low here, I know there's about 5,000 lots traded. That's important information because that's volume. That's actually active traders supporting the market down here. And what happens is, the market rallies. And, if you can start to analyze the order flow, you start, saying, hey, 3,000 traded on the bid, that's a big number. Normally there's only, a couple hundred, 600 trading on the bid. Here you had 1,500, but 3,000, hey, that really sticks out. There's times like that where the order flow just jumps out at you and tells you, hey, there's strong buying here, trade it. react to it rather than, oh, yeah, there's, in the order book, there's 5,000 lots there. Well, as it starts trading there, there's only a couple thousand lots. So, what actually trades, I think, is more important than what has not traded. And, the best way to describe it is commitment. Again, commitment, marriage is commitment, right? Who do you think is more committed in the relationship? The girl on the left that doesn't want to accept the ring and get married, or the girl on the right that's, you're putting the ring on. The girl on the right, she's committed to the relationship. The one on the left, she's not committed to the relationship. So, try to think of things in everyday terms, and that's what's going to help you in your trading. So let me explain further. Orders that are filled, traded, that's volume, and at times is very revealing information-wise to the trader. Now, if someone were to say, hey, I know where big buyers are at a certain level, do you think that's important? Yeah, of course so. What about big sellers? Yeah, the market's rallying, you hit a level and you see a boatload of volume going through at that level, that's going to be very important. And, one of the areas where a lot of traders go wrong in is they think that all prices are created equal. They're not. When going back here, why do you think the market rallied from this low? Why do you think it just stopped down here? It's because you had a lot of volume. That's why it stopped, okay? It didn't stop because, well, it just sort of got down here and just started rallying. It stopped for a reason. It stopped because there was a lot of volume there, okay? And that's important information that's available to you. It's whether you want to look at it or not. It's not every price trades the same, okay? That's because, whether you got one contract trades or 3,000, I think the 3,000 is going to be more important than the one contract. So how do you know where big buyers are or that are supporting the market, or big sellers are that are offering resistance? Well, that comes back down to having the proper set of tools. Knowing where there's prominent point of controls in the bar. Again, a point of control is the level in the bar with the most volume. Remember, volume equals support or resistance. Heavy volume equals support or resistance. And prominent point of control is a point of control that's defined as meeting additional price action and order flow analysis. So for example, you can see here how the markets literally react to prominent point of controls, resistance and support. It sells off from resistance to support up to a resistance area and comes off again. And again, if you know where there's potential support or resistance, you can play it that way. Here, you got the first time you hit the prominent point of control up here, what happens? Market circles back up there, hits that area, and then sells off. Rallies back up to where? Area where you had the prominent point of control earlier. Sells off where? Almost to the area where you had the prominent point of control down here. And then it rallies back up to a new lower prominent point of control. So it's knowing, what was happening in the market and, being able to take those trades. Prominent point of control and divergence. Here you just got a couple prominent point of controls, but when you start adding it in with other parts of order flow, like a divergence, it gives you some very potent trades. You can see how here the market, you have your divergence, right? Your negative delta at the high of the day, and you got resistance up here. What happens? The market starts coming off, goes sideways, rallies right back up to that area of the prominent point of control where you have the resistance earlier before it sells off. These are those great low risk trades because where think about it, where you're going to place your stop is it's just right above that high up here, okay? And excuse me, you're getting short, just right around this level. So, you're risking maybe 4, 5, 6 ticks to get what? From the 85 area down into the 60 to get, that's 25 ticks right there. So you're risking 5 to get 25. So the $1,000,000 question, excuse me, how can you know where hidden aggressive buyers or hidden aggressive sellers are present? Well, you're going to know in the order flow, and specifically, you're going to know with market imbalances. And multiple imbalances can occur anywhere, but when you take them in context, they're going to be more effective. What do I mean, take it in context? Is understanding where a multiple imbalance occurs. Does it happen at the beginning of a move, or does it happen after a move's already happened? So for example, here you have a market rallying, then you got multiple buying imbalances. Do you think that's going to be very effective? Well, it could, but the market just rallied. Instead, what you should be looking at is potential areas to be getting short. So you got a prominent point of control here. then you circle back up and make a new high by a couple ticks, another prominent point of control, then you see aggressive sellers coming in right off that high. That's going to be the better trade than just taking every multiple imbalance or every stacked imbalance by itself. Take it in context with what's happening in the market. And the reason why we added the multiple imbalances is because in order flow, you're taught to look for stacked imbalances. But what if a bar is filled with imbalances, but they're just not neatly stacked on top of each other? Do you think that's important? Well, of course it's important. And why? Think about it. Say you have a bar. Say there's 9 price levels. 5 of them are imbalances, but they're not stacked on top of each other. That's telling you something. That's telling you there's a lot of aggressive trading going on in a certain direction, and that's important to know. So, for example, here again, taking it in context of the market. Here, at the high, you have multiple imbalances, stacked imbalances rather, at the high. Okay. Well, point A, you also got multiple imbalances. It's a 5 range chart, so there's 6 price levels. Half the price levels are in buying imbalances. That's important information, and you can see you could be getting long up here, down here rather, 27.92.5, all the way up to this high where you got a divergence, you got a bearish ratio, you got some signs of potential trap traders before the market starts selling off. Because if you're buying at point B, you just miss this move. These are the moves that you want to catch as a trader. And even in point C, what's happening? The market's starting to turn up here, and you got aggressive selling coming in. You got a divergence, which indicates a potential high of the day, and then what do you see? You start seeing selling, aggressive selling coming in. That's your cue to get short, rather than just taking, if you're not looking at multiple imbalances, you just see the stacked imbalance here, you take it, and it's a losing trade, but you're missing point A and point C to get long and to get short. Multiple imbalances, a sweep, and prominent point of control. You got a lot coming in here. You've got coming off down to a low. You got some supportive buying in here with the prominent point of control. You've got this this green arrow, which indicates a sweep. You actually got multiple stacked imbalances. You got 2 stacked imbalances, and the market goes higher. It's taking this information rather than, as you start to move away higher, you're coming up in here much higher thinking, okay, yeah, you were coming off this low. No, as soon as you're making that low, as soon as you're starting to turn, that the market has potential to go higher. Another perfect example, multiple imbalances, prominent point of control. In this case, market shoots down, dramatic move lower. You hit some support area in here. You got aggressive buying coming in right off this low. That's important information. It just sort of goes sideways before it finally takes off. Where does it take off to? You got another area up in here, a target. Well, it's not a target because once you get up here, then you see you got a resistance up here, so you can get out of the trade. That's how you know to get out of the trade. Now, a lot of guys come into trading thinking that they have to predict the market to be a successful trader. And what they do is they go out and they buy every single book on trading, and they consume it thinking, well, I got all this information. It's just a matter of putting it in its proper place, and I'll be able to predict where the market's going to go in the future. And unfortunately, that's not how it works, because instead of being a trader, you're turning into a fortune teller, and that's not really what you want to do. Don't try to predict the future. Just trade on the information that the market is presenting, that the market is revealing to itself in front of you. Again, it's not about trying to predict highs or lows. It's about the market telling you a high is being made or a low is forming, and taking those trades. Perfect example. Getting back to supportive buying, if a swing low is being made in here, you could be positioned, to take advantage of it when you come back down to that level to catch the move back up. Because, if you're sitting here, you got supportive buying down here at this low the first time you make it, you just throw a bid in here with a stop, 4 or 5 ticks away to catch, 10, 12, 15 ticks to the upside, rather than waiting for this double bottom to form and then, breaking the trend line here, and, you're getting long a point, 2 points higher for what? To catch a point. This is the trades that are going to give you the better risk to reward ratio than, waiting for confirmation, trying to predict where the market's going to go. Trap traders, again, I'm not trying to predict where the market's going, in the sense of the market is telling you, hey, traders are trapped here. When traders are trapped, it's a sign that the market is going to go in a certain direction, because everybody that's short in the hole or long and wrong has got to start getting out and covering that position. And why are they trapped? Is probably because fundamentals have changed. And that's the collective thought of the market has changed. It's it's like when you see trap traders, the way I'd like to describe it, it's kind of like, being late to the party. And, say a market has been rallying, 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 like up here, all of a sudden you got trap traders up here at the high of the days. Why? Because the market rallied from this nice swing low, and then everyone is seeing, hey, we rallied up here, and they start coming in, but they're too late already. Now they're wrong, because the reason for them to be buying down here has changed now that the price is trading 30, 40 points higher, and conditions have changed, and they're long and wrong. So everything's changed. They're stuck. At what point are they going to pull the trigger to get out of that position? And again, trading what's in front of you rather than trying to predict the market. If you know that there's a market sweep going on, that's what this red arrow indicates. If I know there's a big trader coming in, sweeping the market for whatever reason, maybe he's got some information that hasn't hit the market yet. Crude oil traders are very secretive, and I'm talking about cash traders, because they have access to information that a lot of people don't know. They may know there's a pipeline fire or something going on somewhere that hasn't hit the market yet, so they come in and they act accordingly. But it's a 1 minute chart. Over the next minute, you see the move from 74.15 down to 74.00, and over the next couple minutes down to 73.90. But that this is valuable information. You don't need all this knowledge about, oh, I need to know that you have this pattern or that pattern. No, I see someone swept the market. Hey, you know what? I could take a trade off that. That's about trading in the present rather than trying to predict where the market's going. One of the big reasons why a lot of traders fail, and I've, since I left the corporate world, I've worked with a lot of retail traders, and one of the things is they always show me these setups, and they're like, well, I'm waiting for confirmation before I take the trade. I'm just like, well, what are you going to do in the meantime? Are you going to trade or not? And I've even seen guys, show me these charts, they're showing these big chart patterns, and maybe it's on a daily chart. Oh, I got this formation setting up, and I'm waiting for confirmation, and my target's over here. Well, the target's 3 months down the line. There's so much that could happen in 3 months, especially now with the way with Trump in office. So much can change in the markets that trying to predict something 3 months out is kind of ridiculous. So you got to start trading. Stop waiting for confirmation. Oftentimes people like to say it's that comfort, because they have confirmation, so they don't need to jump into the pool. They don't care if it's hot or cold. If that's what good traders do, is they trade the market. They don't sit back and say, well, I'm waiting for everything to line up. I'm waiting for the planets to line up. And ultimately they just end up losing, plenty of opportunities. On a simple chart, people say, well, yeah, I got triple bottom and I could buy up here when we break that trend line. Well, what about all this stuff that's happening in between the low, the bottom, and this trend line? You're missing all these opportunities. And it's a shame because maybe they'll get a trade, maybe they won't. At this point when it breaks here, yeah, does it have a chance to go higher? Yeah, maybe it's 65% chance, but then you got a 35% chance it's going to fail. But in the meantime, you just missed all this great trading opportunities in there. And just yesterday, I think it was, or the day before in the S&Ps, it's just literally like that. And this is the order flow here. You got supportive buying down here with this prominent point of control, multiple imbalances coming in here. So what do? How do you trade it? Well, you throw a bid in here around this level down here near this low, waiting for a pullback. And you could get in here at 28, call it 28.19 right in here, just above this blue bar here. And then your stop is just right below here, 28.18. You're risking 1 point in the S&Ps, 4 ticks. And rather than waiting for, to break this trend line on these highs up here at 28.21 and a half, you're giving up 2.5 points right here, waiting for confirmation. When if you're a trader, you're trading, right? That, oh, I got support down here, I could get long. I could throw a bid in here. If we come back, great. I just picked up an extra 2.5 points here, rather than sitting on my thumb waiting for confirmation to come in and getting long up here 2.5 points. Is this any more effective than where are you gonna then throwing a bid in here? Where are you gonna place your stop in here? Your stop's probably still gonna be down here anyway. So where would you rather be long from? Down here, where this blue arrow is with a stop, right here, or long from up here with a stop at the same spot. It's going to be more effective to get long down here with a stop at the same level than giving up all this trading opportunity to catch, this breakout up here, because you know that information. You see it in the order flow. I mean, that's the beauty of order flow. As traders, we tend to overanalyze things, and rather than just trade them, like I said, we sit there, I got to analyze this, got to analyze that, and so they want to wait for confirmation instead of actually trading. It's not about trading at the seat of your pants. It's about taking the information, synthesizing it quickly, and making a decision. At some point, you got to start trading. Now, and that's why it's good to have order flow setups. And people that know me know that I have bread and butter setups, or ratio and divergence is one of my bread and butter trade setups. And I'm not gonna get into it here, but yeah, I've got tons of videos on it. But what I've got is a new additional setup. I mean, you just go to YouTube. I got tons of videos on YouTube about this setup, but this is a newer one that a lot of people have been having a lot of success. I've been getting a lot of great emails on it. It's two tools involved in it that come with the order flow trader. It's the prominent point of control, which I explained considers support or resistance in the order flow, and the divergence, which is a new equal high with negative delta, or a new equal low with positive delta, and confirming price action. Now, a lot of software out there doesn't have the confirming price action, and I think that's what makes mine different, is because it gives you an extra tool to analyze the order flow. You got to combine some sort of price action. If you're getting short, you want some confirming price action to it. Or if you're getting long, you want some confirming price action to it. And you can see, why is it great? Because divergence generally will occur at a high or a low. And when you add in support or resistance to it, it gives you some great trading opportunities. Imagine getting short at the high up here, or around here, just after off to the high in the next bar. I like the bar to close before I get any position. Market sells off from that high, 27.47 down to 27.41. Here's another one, E-minis, again, 27.50 down to 27.43. Bonds, at your high of the day, you're getting short here around the 22, 23 area, down to a supportive area down here around the 13, 14, 15 area. Prominent point of control, low of the day. Prominent point of control, divergence. What happens? Rallies from 24.720 all the way up to this prominent point of control resistance up here at 27.50. Euro currency this time. Down here at the low of the day, prominent point of control. So you got support, you got divergence. 117.98 all the way up to 118.10. Buns. So I've showed you E-minis, I've showed you mini Dow, Euro currency, buns. It's happening. It happens in all these markets at the same time. That's why I created the software, is because I want to be able to see different markets at the same time, rather than just being focused on one market. I want to have multiple opportunities during the day. Prominent point of control, test it even once, twice. You got triple bottom in here. Even down here, you got a ratio and divergence, and you see how the market rallies up from the point of controls, prominent point of controls and divergence, ratio and divergence. Again, this is similar to what I was talking about earlier. Why wait for a break of this, this trend line here to get long at 162.32 when you can get long down here at 162.27? That's an extra 5 points that you could pick up in your trading. Then again, when you start putting it all together, now I'm not talking about Confluence, specifically, but here you got everything pretty much. You got prominent point of control, you got divergence, you got trap traders, you got a bullish ratio, all right in this bar on the low of the day. The only thing you don't have here is a stacked imbalance or a multiple imbalance. But what happens, this is your low of the day, and everything in the market is telling you, hey, you should be getting long in here somewhere. Don't miss this trading opportunity. And market rallies from 27.42 all the way up to 47. I mean, up here 44.5, you do have a prominent point of control. So maybe you'll take something off up here around 44, hopefully. So you could have got 2.5 points out of that move. So hopefully by now you can see how powerful order flow analysis has become. And it's really like having the software, I think, is like having me sitting next to you while you're trading, pointing out the little market nuances in the order flow that you probably wouldn't pick up. Can you learn this by yourself? Sure you can. It might take you time, you might never learn it, but time is money, especially in this day and age. Do you have the time to sit around for the next year and try to learn this on your own? Or do you want to take some action and get the Orderflows Trader software? And I've got a terrific deal for you guys. and I'm really excited about it, is because it's the Orderflows Trader software 2.0 for NinjaTrader 7 and NinjaTrader 8. I said we just went back and reprogrammed the NinjaTrader 7. We weren't going to. We were just going to do all further development on NinjaTrader 7, but I've got a lot of users still on NinjaTrader 7. Rather, we were only going to do new developments on NinjaTrader 8, but we went back and updated in NinjaTrader 7 to include these tools as well. So if you're still on NinjaTrader 7, you can get access to it. And it's the volume footprint chart with the 7 pre-programmed order flows tools I discussed in this presentation. But more importantly, you get my chart template. Okay, that's value right there. You can just a few clicks, your charts will look just like mine. Normally I sell this for $8.99. Now, I realize that just having software is one thing. You got to know how to use it. So I give you further education. I'm big on education. I really want you to teach you how to trade rather than just say buy here, sell there. So I give you access to my trading course, which is normally I sell for $297. And more importantly, this is I think is a great deal. Is also you get access to the Inner Circle video series. So there's 56 videos on advanced order flow tricks, tips, and analysis. I know you're thinking, wow, 56 videos, oh, that's so much, I'll never learn it. You don't even have to, but there's certain different little things of order flow that I think once you start delving into it, you want to learn as much as possible. And that's a great resource for you as a trader. So you start adding it up, it comes out, it's expensive, it's $16.93 if you were to buy this separately, and people have bought all this stuff separately. But I'm not going to charge you that today. And because of Investor Inspiration, I got a special gift for you, a special bonus. It's access to this Trader Kickstart course I created this year. It's about the mindset of a trader, what makes traders successful, how to create a trading plan, how to go about setting a daily routine, and a lot of different things. And I'm going to throw that in for free for you today. So you start adding this up, it comes out to just under $2,000. It's $19.99, but you're not going to pay that. You're just going to pay $7.99. And you go to orderflows.com/off.2.html, and it'll take you to the sign up page so you can purchase it. But what I'm really excited about, what really I think is going to give you a lot of value is I've created this new online group training, live group training with me every week. It's on Monday nights, and basically what it is I come into a trading room, my old trading room, and I'm there to answer questions. I'm there to explain things about order flow. And if you can't attend, that's fine. They'll be recorded and they'll be in a special members only area. Now these videos will not be posted anywhere else. They won't be on YouTube. They won't be available to people. They're only for traders that use my software, because I want you to understand how to use my software. Say you don't understand how to set up your chart properly, or you don't understand what a setting means. You come in here, you could ask those questions and you get your help. Say you switch in your machine ID, or you're going to go on vacation, you want to switch it to a laptop, you can come in here and just tell me that. And it's there. It's a resource for everybody that uses my software. So you don't have to worry about, oh my gosh, is Mike going to answer my email? Sometimes I get 700 emails a day, honestly, and there's probably about 20 that apply to the software. Unfortunately, sometimes I miss them. People get angry at me. So this is where I will be every week. So even if you email me, you don't get a reply, you can come in here. I will be there. I'll be there to answer your questions. To interact with you, and it's available for everybody. So say you buy my software today, you don't go into this room for a month, that's fine. As long as you have my software, you could access this room at any point going forward. So it's don't be afraid that, oh, I got the software but I can't get an answer. No, that's what this room is there for. It's there for me to be there for you, to help you out in every step of the way. And normally I used to mentor traders. I do it more on a selective basis now, and it's very expensive. I charge $2,500 for basically 5 hours to sit down. I go through an early session, and then we sit down and work on your trading plan and how you're going to approach the markets. So just 1 hour, this is about $500. So this, you get access at least 1 hour each week to me. I know it's not going to be one-on-one, but it's a group session. Even if you just attend it twice, that alone is worth $1,000. It's a good resource for you as a trader if you want to advance your trading. And again, all you do is just go to orderflows.com/off.2.html, and it takes you to a sign-up page. Just scroll down. You can watch the video there. Scroll down and say, yeah, I want in. You should be all in on everything you do, especially in trading. And You know, if you stuck around to the end here, I'll show you how to get a copy of my book, Trading Order Flows. Go to orderflows.com/book.html, and it'll take you to the page where you can just enter your email address. And once you confirm your email address, you'll be revealed the link to download the book. Now, you know, why you should adopt order flow in your trading is because, you know, see what other people are saying about, you know, how it's changed their trading. It's gone on, you know, Sheila writes, you know, your order flows trader software is remarkably helpful. I can clearly now see what's happening in the market. Like, for example, who's in control of the market on a very specific time and who's getting weaker as well. You know, you should always want to be improving yourself as a trader. Stop flushing your money down the toilet looking for, you know, the next shiny indicator, and learn how to trade. So act now.